Welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Sam Lau.
Hey.
It's 10 a.m. Pacific time here on December 20th, the last podcast of the year for us here, Sam.
Yeah, taking a couple of weeks off for the holidays.
Yep, and that seems pretty quiet after the fireworks that we got this week. But given the market moves, given what's happened, why don't we jump right into the where are we for the week?
Yeah, so where we are, it's a pretty red week looking across the board here. Yes, indeed. S&P 500 week to date thus far on this early record is down about 1.25%. Everything within the sectors that we look at here, all 11 are in the red. The bookends here, best performing on the week to date is technology. That's down 0.75 points. Worst performing on the other side is down 5.5, and that's energy. When we take a look at across the various other indices that we look at for the U.S. equity market, Russell 1000 down 1.5, Russell 2000 down 3.75%. Switching over to the Russell 1000 growth versus value, growth is down 0.75%, value down 2.5%. So overall, very red across the U.S. equity market. Since this is our last episode of the year, here we are in the 20th day of December. Might as well just give a quick standing of where we are in terms of the year to date. It does look like the S&P 500, barring any huge spectacular move to the downside, is going to remain positive for 2024. Right now, it's up just under 27%. One of the surprise best performers in the year of 2024 had been utilities. It's kind of lost that mantle place right now. That's hovering around positive 24%, but that's not something you see very often for the utility sector. But right now, what took the first place is communication services. I think that just happened in the last few weeks here, but that's up 37%. We have two other sectors as of right now with a 30 handle. I'm not sure if that's going to last through even next week, let alone just the rest of this year. But consumer discretionary up 30%, 30.7%, let's say. And then we've got financials up 31%. But everything across the board for tech, for the S&P 500 on a year-to-date basis with regards to the 11 sectors are in the green at this point.
Sam, I'd say that if we start flirting with a negative year on the S&P 500 in the next week or 10 days, that we'll do an emergency pod.
I think that's warrants in the emergency pod and, perhaps some shelter taking as well. So we'll see here. So stay tuned. Hopefully we won't have another pod for the remainder of this year. And I believe it's the first week of January as well that we won't have one, but let's take a look here. We'll see. Moving over to the fixed income side of things, we have starting with the Treasury curve. The Treasury curve for the 2-year note, the yield there is sitting at a yield of 4.3. That's up on both a week-to-date basis as well as a year-to-date basis, up about 5 basis points in yield. Last Friday, we closed with a yield of 4.25, as we did at year-end of 2023. So pretty much, I guess you can call that a flat, across from that standpoint. Moving over to the 10-year yield, at right now sitting at a yield of 4.5%. That's up about 10 basis points on the week to date, as is the bond. The 30-year Treasury yield is also up about 10 basis points, respectively. It's sitting at 4.5 for the 10 and 4.7 for the 30-year bond there. But we did see the curve steepener, persist through the year, or at least through this point in time. Right now, as I mentioned before, the 2-year is up 5 basis points in yield from year-end 2023. Right now, the 10-year and the 30-year bond are up about 65 basis points over where we closed last year in yield. So what does that mean for the aggregate bond index? So looking at the U.S. Bloomberg bond aggregate, that's down 50 basis points on the week-to-date basis, similar to what we just talked about for the S&P 500. Every cohort that we look at for the fixed income market is also down this week-to-date basis. The bookends here, best performing bank loans is down 20 basis points. Worst performing is emerging market sovereign debt, down about 1%. And I'll give it a tie for for the worst performers, I'll just call IG Corporate Credit US, also down about a point here on the week-to-date basis. But again, similar to what we saw with the U.S. equity sectors, the cohorts underlying the underlying the fixed income side of things that we talk about here are all in the green on a year-to-date basis. But let's just start with the ag. Ag up 1.5%, trying to hang on to this positive number going into year end. But not only the sectors underlying the ag, but also some of the non-index sectors there are also all in the green. But leading the way are the down in credit sectors of the market. You've got bank loans and U.S. high yield corporate credits, each up about 7.9% on the year-to-date basis. EM sovereign debt up about 6%. Worst performers are the sectors that underlie the U.S. bond aggregate. You got U.S. Treasuries worst performing up 80 basis points, and then you have IG corporate credit and agency MBS each up about 1.3 or 1.4% there. Just to wrap it all up, let's move over to the commodity side here. WTI crude oil right now sitting at a spot price on the front month futures contract of $69.61. That's down about 2.25% over the previous week, down about just let's call it 2.9% on the year-to-date basis there. So what has performed well though on a year-to-date basis has been gold. Gold is up about 27% on the front month contract for a troy ounce of gold. Right now, that puts it at a dollar price of $2,627. And as I see it right now, that's a 0 cents right there. So I think I said that wrong. $2,627, 0 cents right there is what we're sitting at this time of recording. That's up from just under 2,100 a troy ounce for gold at the year end of 2023. What this means for the Bloomberg commodity indexes, that's hanging onto a positive print right now for the year-to-date basis, up just over 4%, but on the week it's down 1%. So kind of getting, like you said, a little bit of fireworks this week, at least across all these various asset classes that we take a look at. But Jeff, do you want to kick us off on what happened this week?
Yeah, it started off pretty slow. We got the S&P Global Manufacturing and Services PMI numbers on Monday. Let's see, manufacturing came in a little bit less than expected at 48.3. Was expected to be 49.5. Services came in stronger than expected at 48.5 versus a 58.5 versus an estimate of 55.8. The big beat in the services side brought the composite number to 56.6 versus an estimate of 55.1. Then on Tuesday, we got retail sales. That number came in at 0.7%. That beat the 0.6% expectation. Take out autos and gas. That was actually below expectations, though, at a 0.2. I was expected to be a 0.4. And the control group, the part that goes into GDP, came in right on expectations at 0.4%. So nothing really too market moving there. Obviously, the big market moving event of the week was the Fed decision on Wednesday. We'll talk about that shortly in the topic of the week. But needless to say, the Fed did cut 25 basis points. But that's not really the market reaction. Wasn't to the 25. It was for the future forward guidance there. Thursday, we got the GDP number came in for the third quarter. This is the third estimate for the third quarter. Usually this number doesn't really move very much, but we got a pretty big jump here where we went from a 2.8 from the previous estimate to a 3.1. So economy still looking strong. Wonder if Jay Powell had the early look on that number when he was giving his press conference there on Wednesday. Thursday, we also got the jobless claims number. The initial claims came in at 220,000 versus a 230 expectation, so a little bit lower than expectations. And the continuing claims came in at 1.874 million versus the expectations of 1.892. So again, from the jobless claims side of things, the labor market is continuing to be pretty stable. Nothing to worry about there. And then also on Thursday, we got the leading economic index. That number is actually positive, a positive 0.3. It was expected to be negative 0.1 and a negative 0.4 last month. So that number has improved slightly, though it is still very negative and still is the the wrong clock, or the stop clock, telling us that we're still in a recession, given the absolute year level. Then this morning we got personal income came in slightly down from expectations and prior month. Personal income for November came in at 0.3% versus a 0.4% expectation. Spending came in at 0.4 versus a 0.5% expectation. So down slightly, but still a positive trend, still going well. And then kind of the big number here today, we got the Fed's preferred inflation gauge. We'll start with that. We'll start with core PCE, came in at 2.8 versus a 2.9 expectation. So slight down there. That's a year-over-year number. Slight down from expectations there. Flat on a month over, flat from previous month's year-over-year number. But really, the headline PCE came in at 2.4 versus a 2.5. That was the market expectation. That was kind of what Chair Powell hinted at, a 2.5 number. So maybe it's a lot of it's just on the round, but really when you look at it, maybe a little bit of a softening, maybe a little bit of the market saying, okay, maybe the inflation isn't out of control, isn't going too crazy. You kind of saw that today in the market reaction to get us back to like 450 there on the 10-year from where we were yesterday. And that's about it from the macro side of things, Sam.
Yeah. I mean, that's getting into not trying to front run what we're going to talk about on the topic of the week here, but each one of these data points seem like they're going to be a lot more. The market's going to be a lot more reactive to some of these data points, especially the surprises going forward, given some of the uncertainty that we kind of gleaned from the Fed presser and the FOMC itself. So we'll take a look to see what happens.
Yeah, and it's interesting. Looking out forward, and we have a 10% chance of a cut in January, so it seems like the Fed's going for a pause there. But we'll talk about kind of future looking when we talk about topic of the week here.
Go ahead.
I was gonna say, and the topic of the week is the Fed. Obviously, they did cut 25 basis points to a range of 4.25 to 4.5. They did say there's no change to the balance sheet runoff. And the comment on the trading desk was, "Oh, I forgot about the balance sheet runoff." And the comment was, "That's exactly what the Fed wants you to do."
Exactly.
So run in the background. There was a dissent though. It was Fed President Hammack, and she said that the dissenting vote was driven by inflation worries and prefers to see more progress on prices before cutting. So it was interesting that it was Bowman that dissented in September, and now she's okay with this cut, but we have a dissent here from someone else in December. So and Bowman, so that means Bowman was along with this cut. So kind of I would say not a flip flop there, but it's certainly a interesting change that can happen over a quarter. And speaking of changes that can happen over a quarter, Sam, once you hit up on the dots that really cause the market to kind of second guess itself.
Yeah. I mean, I guess the one of the things here that you see is, despite some of these dissents, the number of cuts in terms of percentage point, we were looking at the Fed had indicated a 1% cut in total in cuts for 2024. That came in right at the screws for the dots relative to where we were in the last SEP, which came out in September. But what changed is going out for the dots in 2025, rather than what they had projected. They, meaning the FOMC, had projected into September SEP, Summary of Economic Projections, was for another 100 basis points in aggregate of cuts to the federal funds target rate, putting the upper and lower boundaries at 3.5 and 3.25 for that September projection. That has now shifted higher by 50 basis points. So right now, for the December median dot on the projection now is in a range of 3.75 at the lower end and 4 at the top. So that was a pretty big change, and as you said, that caused some consternation among market participants. We saw some pretty big moves on this past Wednesday there. But when you take a look at some of the other projections that may have changed between the last 3 months, one thing when I take a look at with regards to this policy change is starting out with their expectations for changes in the real GDP. So for prior in September, they had projected a 2% real GDP print in the year end of 2024. Now they've upped that up to 2.5%. With regards for their expectations for 2025, it's pretty much in line. I mean, these are projections after all, but previously it was at 2.2% even. Now it's at 2.1%. So really taking a look at this year, they're expecting a 50 basis point higher move in the real GDP for what we'll see for the December print of 2024, which is due out early next year. Further to that, when we take a look at one part of their dual mandate, which is the labor market, what they had previously expected was for a higher rate of unemployment at 4.4 for the year of 2024. Again, December data for 2024. Now they've backed that off a bit and forecasted a little bit stronger labor market as reflected for the U3 unemployment rate down to 4.2%. Again, I'll say that the projection of 2025, similar to real GDP, is kind of in line. They tweaked it slightly, bringing it down to 4.3 from 4.4 previously. In a similar vein, the second part of their dual mandate, they did increase the projected headline inflation from 2.3 in September to this most recent projection up to 2.4. But more importantly, for 2025, they do see a little bit hotter than they would like type of inflation for the headline side. The September projection was for 2.1. This most recent December projection bumped up by 40 basis points up to a rate of 2.5 for the headline there. And then finally, rounding it all out, their purported, preferred measure of inflation that they like to look at, the core PCE inflation number there, that also increased as one would expect, going from, for the 2024 print, they are expecting in September a rate of 2.6. That increased by 0.2% up to 2.8% in their most recent projections. Similarly, for 2025, that also was increased from 2.2 up to 2.5. And then I'll point this out as well, because even though it's a little bit farther out in the calendar, it was a little bit bigger of a jump than what I just rattled off for some of these other categories. But the projection for core PCE in 2026 increased by 0.2% up to 2.2 in the most recent December print. So, there's a little bit of method to their madness, if you will, is like we like to say here on the Crass Asset team sometimes. But that change in the federal funds rate is corroborated by their changes in what they see in their projections for the various portions of the economy as well. So with that roundup, Jeff, do you want to tell us what you gleaned from the press conference, sir?
Yeah, I thought it was interesting that, the Fed is saying it's going to take them longer than they expected to get down to 2% inflation. 2027, even though it's just around the corner, seems like it's very far in the future. The presser was kind of boring. It wasn't not too much going on. Everyone was worried about kind of how to judge how fast the Fed is going to move in 2025. How are they going to decide whether they're actually going to do their 2 cuts in 2025? And so I pulled a couple of quotes from Chair Powell that I thought were interesting that kind of talk about this idea. He did at the very beginning of the first question, he did say, we couple this decision today with the extent and timing language in the post-meeting statement that signals that we are at or near a point at which it will be appropriate to slow the pace of further adjustments. You ask about 2025. I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut. I think the actual cuts that we make next year will not be because of anything we wrote down today. We're going to react to data. And then also, talking about the uncertainty. And really, this is one of the questions that come up a few times is like, with the new administration coming in, uncertainty about their policies, what they're going to actually be able to do. How do you react to that? And so it was kind of interesting. He did say, I didn't write this quote down, but he did say that some people were taking in some sort of policy. Some people were saying no policy. or they didn't incorporate any policy changes into their estimates. And some people didn't say whether they did or not. So you kind of ran the gamut of every possibility there. But Powell did say, a quote here said, some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation. The point of that uncertainty is it's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture. You just slow down. End quote there. And I think that makes sense. They don't know what's going to happen. They don't know what kind of the future of, if the tariffs are going to be inflationary or not, or retaliatory. And it makes sense to like couch some of that uncertainty in your projections, even though, the projections don't really mean anything, right? You can obviously adjust on the fly with what's actually happening versus what your expectations are or your projections are. But I think it makes sense to bake some of that uncertainty in, slow down, see what happens. That's why there's a 10% chance of a cut here in January, because that's a big unknown period of time. The next meeting after that is on March. Oh, sorry, that's 2024. Gotta change the calendar to 2025. March 19th is the next one after the January 29th meeting. So we'll have a little bit more information there. Then we go to kind of May 7th. And that's really the first point. We have about a 50% chance of a cut in March. It looks like only time we get to a 100% chance of a cut is in the June 18th meeting. And then the market's pricing in almost half a cut for the rest of the year. So only 1.6 cuts in price for 2025. So even discounting the Fed's 2 cuts from their Fed's 4 cuts from the September SEP. And so it's interesting to see that was kind of the market reaction was like, the Fed's going to not be able to cut as much as the Fed wants, as much as the market had wanted. Remember, this time last year, we're getting pretty close to the 7 cuts in 2024. We got 4 of them. We're not even going to get anywhere close to that, in those 2 years, 2024 and 2025.
Yeah, definitely a lot of excitement in this, this part of the market that one wouldn't really expect, the world interest rate probability calendar here as we get into 2025 and beyond. But I think a big part of that is uncertainty, is just what the administration has in store for the economy and the populace. And this is something that Powell had mentioned in the last presser, where he basically just said, when there's a lot of questions about the impact of potential tariffs and policy, and he just says we can't model that in yet because we don't know anything about it. But if you start to get into 2025, as you mentioned before, some of the 2 key ones where you're starting to see a 50 and 100% priced in 25 basis point cut is in the March and the June, and those are when the SEPs come out as well, the summary of economic projections. So it'll be interesting to see how these dots shift over that period of time as they start to potentially get more clarity around policy from the administration. But it'll be interesting to see not only those dots, but then what the median projections again are for the GDP, inflation, and unemployment rate as they start to get a sense of what tariffs will be like and what the potential impact will be around inflation in particular.
Yep. And with that, let's go move on to the things to keep an eye on for the next 2 weeks. Sam, there is a podcast on the 3rd. On the 24th, we do get durable goods orders. Those are expected to be a little bit down from the prior month. On the 26th, we get initial and continuing jobless claims. No surveys out for those yet. On New Year's Eve, we get the S&P CoreLogic Case-Shiller 20-city home price indices expected to be flat at a 0.2% month over month on a seasonally adjusted basis. And then on January 2nd, we get initial and continuing job claims again. And then finally, to round out the next 2 weeks, the beginning of 2025, on January 3rd, we do get the ISM manufacturing numbers for December. That's expected to be at 48.5. Prior month was 48.4. So still contractionary there from a manufacturing side, and nothing really to change from that. And with that, that's kind of the roundup. So should be a pretty quiet next couple of weeks from a macro perspective.
Yeah, which is always a nice thing, especially because liquidity starts to thin out as we press further into this holiday season.
That's right. Today's I thought one of the biggest option expiry days ever, if not the biggest ever. So I think that markets will kind of take a breather here for the next couple of weeks.
Yeah, I think it was a triple witching today, if not
Not the
a
quad.
quadruple, right? A
Yeah.
quad witching. So
All right. I think that wraps it up for this week.
yeah. I want to thank everyone out there for listening to us out there today, as always, on Double Line Minutes. Don't forget, you can always hit us up on the X at DLine Minutes, or you can send us an email at minutes@doubleline.com. If you have any suggestions or comments for the future topic of the weeks, we always appreciate that.
Yep. Don't forget our YouTube channel is youtube.com/DoubleLine Capital. We have both of our Fed Day appearances by Jeffrey Gundlach on CNBC and Ken Shinoda on Bloomberg. And with that, Sam, do you want to make your big announcement that we teased both on the Spaces title and in the tweet that Jason sent out earlier?
Oh yeah. So for our listeners out there, I've made the decision to retire at the end here of 2024. So I will be riding off into the sunset to work on becoming a gentleman of leisure. The working part will be on the gentleman portion. The leisure part, I think, will come a little bit more naturally. So this is my last episode of Double Line Minutes here with Jeff. I don't even know what episode we're on, but we've put out a lot of these since we started out during the pandemic in response to some of the questions that we were getting around markets from our clients during that period of time. We thought this would be a great way to keep people, abreast of some of the ways that we're thinking here on the desk, at least at Double Line during that tough time during the pandemic. But definitely wanted to thank all of our loyal listeners out there. A special gold star to our long-term listeners out there who have really, it's surprising, Jeff. I see there's, we get questions from listeners that have really been with us since 2020. So gold star medal for that. Gold star for our production team here, everyone that behind the scenes, that you don't necessarily hear their voices, but a lot of work goes into putting these podcasts up on this weekly frequency that we have, just a few hours after we record on the Friday. So thank you for everyone involved in that. And of course, gold star I should give out to our most consistent listeners, Barb out there listening every week. And then of course, Mama Mayberry out there pretty much every week as well, so gold stars all around for everyone. How about that?
All right. And that's Sam. That's why you didn't know there was a podcast on the 3rd, because you'll have been retired by then.
That's the leisure side of things.
That's right. And I expect to see you on here every week at 10 a.m. on Fridays, listening to me and Mark and Eric. And maybe we're going to add another voice here to us every week here. But I'd like to thank you, Sam, since this was my crazy idea and you begrudgingly accepted the role of co-host. So I'd like to thank you for that. And we are on episode 195.
Yeah, it's pretty amazing.
All right. With that, I'd like to thank everyone for listening and hope everyone has a great rest of the year. And let's go look forward to a great 2025.
Yeah. Thanks, everyone. And good luck out there.